Per usual, living on this channel is for educational purposes only and is not intended as financial advice. Let's take a look at some macro charts today. A few days late, but probably better off now that we are post-hot CPI print. As far as the rest of the calendar for the week, we've got a bunch of Fed speakers tomorrow. We've got a bunch of Fed speakers Friday. We've got PPI tomorrow. The big event for the week, which was CPI, is now over. And once again, that came in hotter than expected, aka higher than expected. So that sent the market in a little bit of a tizzy, because if inflation remains above expectations or is headed in the wrong direction, then the likelihood of rate cuts drop significantly. If rate cuts drop any rate sensitive sectors, regional banking, small businesses, businesses that require credit or lending, individual consumers that require credit or lending, mortgages, that sort of thing, all that stuff gets angry. So this is the CPI print year over year back since 1990. And as many people have sort of been suggesting on CPI, we may have hit a near-term bottom, an interim bottom in how far CPI can actually go down. So if that is the case, the Fed has even less ammo to rationally cut rates. Now, if they cut in the face of this, in the face of unemployment where it's at, there will be increasing calls for the Fed being politicized and not being independent. The next Fed meeting is in May 1st, so we'll find out exactly how Powell wants to rationalize this print. The previous two prints, he sort of rationalized it by saying, well, two prints a trend does not make. I think it's going to get harder to rationalize away this print, which continues to be hotter than the last. If we look at the categories individually that are still up year over year, car maintenance and repair all the way at the top, likely due to age of vehicles on the road. I'll get to that in a second. Hospital services, owner's equivalent rent, that's OER, that continues to come down. Rent also continues to come down. Energy and electricity, both up and down. And of course, we all know, I think, if you eat out at all, or you have eaten out in the past year, food away from home is just out of control. The biggest benefits we've seen from energy coming down is probably over, especially based on the gas prices we've seen creeping up week over week for the past couple months. This is from Car Dealership Guy. Age of vehicles on the road has reached an all-time high. And if you think about it, everything in the macroverse is all connected. So if rates are high, getting a loan for a car, a new car or a used car, is high. This keeps people in older cars for longer. So this likely puts strains on something like vehicle maintenance and repair, on insurance, on keeping these older cars running and on the road. So there's all these second and third order effects relative to what rates are at any given time, which is why there's always this massive focus on rates. And as Craig Shapiro puts here, no matter how you try to cut CPI or these numbers, it's very hard to come away with a dovish argument, which would mean cutting rates. This is the super core metric, which the Powell has mentioned a few times, continues to creep up. So there really isn't any justification. If an algorithm was figuring out where rates should be, I don't think that robot would decide to cut rates anytime soon. So after the CPI print, I mentioned this last night, but after that print, the probability is all shifted for the most part towards decreasing odds of a cut. Now, we came into the year with the expectation of 6 cuts. If we end up with less than 2 cuts or a hike, that's going to be the opposite of expectations. That will anger risk markets further. So just something to keep in mind. We have a lot of data prints between now and the election, between now and July, now and September. But as of today, there is no cut priced in until September. And even then, it's a little bit of a coin flip. So this hot print sent the belly of the curve on yields higher. It sent long-term yields higher, prices down, keep in mind. So things like TLT took a spill lower. The regional banking index took a spill lower. All of the regional banks that were sort of already swirling down the drain continue to look worse and worse and worse, because the probability of a cut of rate relief continues to get pushed out. The brown line here is today's rates, and relative to the previous week, even relative to the rest of the year, these rates are rising pretty rapidly. And from the risk perspective, it just means there's less justification to take risk if you get paid to stay in cash. And so the market is constantly fighting this yin and yang between, is there a yield? Yes. Is the yield justified based on short and long-term predictions of where we think the market is going? And I'll talk about that more when we get to the S&P chart, but I think it's hard to justify in the near term and the midterm that legacy markets are going higher based on how the charts look. So to me, it makes more sense to sit in the short end of the curve here and wait it out, wait for things to look better, than to fool around with trading a momentumless market. And on top of all that, we get this today from Uniswap saying that they've been served a Wells notice from the SEC, which means the SEC will be suing them. So again, back to crypto, from an alt perspective, from a crypto ecosystem perspective, higher for longer is a headwind for alts. A hostile regulatory environment is definitely a headwind for alts. And so back to the probabilities and likelihoods of bullishness in the near term, it just isn't there. So yes, a meme coin can go up 25 to 50% in a week, but broadly over the long term, it's going to be tough when rates are as high as they are and the DeFi ecosystem is being attacked by the US government. In Uniswap's response, the SEC charges, it sounds like, are going after both the token and the exchange itself. So that is bad news for many of these DEXs and meme coins on Solana, right? On any of this stuff. That doesn't mean they're all going to zero. It doesn't mean they all have to be negative. Again, it just means there's a headwind against a lot of this stuff if there's an expectation that eventually legal action will be taken against many of these products. And clearly the SEC still has an active stance against going after much of the crypto ecosystem. Looking at money market funds, because rates are as high as they are on the short end, for many people, again, it just makes more sense to stay in cash and get paid than worry about a drawdown or protecting yourself from a drawdown. This doesn't have to be all or nothing. As an example, you can put a percentage of your stack in a short-term yielding vehicle, whether that be a money market account or treasuries or whatever, and just wait it out until the all clear signal is given on trend metrics or making a higher high on Bitcoin, for example, above 74. Total assets in money market accounts back to a record high, $6.11 trillion. So sure, this is dry powder, but realistically, is this dry powder shifting into risk assets quickly when rates come down? Probably not, right? Just look at historically what's happened here since 08. Generally, we establish some sort of new high, and then things come off slowly, but we never really go back down, right? A lot of this stuff just sort of perpetuates in money market accounts, regardless of rates at the time. And as a sentiment gauge, this just says, again, this is where the money's going, right? It's going into money markets rather than risk on the equity side. This is the regional banking index, which I mentioned, KRE, down significantly today. On a trend basis, it risks a bearish breakdown, which essentially measures to the SVB blow up in 2023, thereabouts or lower. Even the October low, certainly on the table. So maybe we do see some more banks start to explode here if it's truly even higher for longer relative to expectations. TLT, like I said, the long bond ETF, down significantly today. Bearish Kumo twist on the cloud, breakdown below the cloud completely now, breakdown below the descending triangle. So this may get real ugly for regional banks, especially now that BTFP is over and they cannot access that. Anybody with the long bond stuff, and that may be why KRE is down even more. There isn't a safety net to access because BTFP is over. We also had a jobs print last week, and I know this is hyper controversial based on short-term jobs versus full-time jobs versus U.S. citizen jobs versus immigrant jobs, but the number was the number. The number non-adjusted was positive 303,000. And if the Fed is looking at this, this is not justification to cut if unemployment is low and inflation is high. All the more reason for them to do nothing and just leave rates where rates are. Yield curve still inverted. Unemployment historically low. Historically very low. So it just doesn't make sense. Again, if the Fed was an algorithm, why would they cut here? There's no reason to cut based on those employment numbers. This from Michael Howell looking at global liquidity. We are in a positive upswing for liquidity, which has certainly helped crypto and meme coins and legacy over the past 6 months. But that's never a promise that we have a continuous upswing, right? If we look historically since the 70s, this GLI long-term cycle has roughly followed this pattern, but it isn't always sunshines and rainbows on the way up, right? And so Michael Howell for weeks now has been arguing that in April, because of the tax season, because of general drops in liquidity around this period of time, it's going to be tougher for risk assets to do well. And so far, that's been true. It's lined up. One thing we are also not seeing anymore is a drain of the reverse repo. We may have hit the floor for reverse repo relative to where money markets were pulling money out of reverse repo and into short-term treasuries. So that may mean going forward, yields may creep higher generally, which they are, as well as money being taken out of risk and into yielding instruments, because again, it just makes more sense. If we're ping-ponging back and forth between this pendulum of 6 months of bullish risk on, now up here, maybe momentumless chop for a few weeks and or months until there's maybe a technical catalyst or a fundamental catalyst to bring the risk on sentiment back. As far as a call, I mean, this is a very early quote unquote call from me to say, hey, I think things are going to start to roll over. I could be totally wrong here, but I'm certainly not seeing justification in the charts for bullishness across the board here. And you got to love headlines like this, because over the long term, high rates hurt us all at the end of the day. As much as we can say we love 5% rates and getting yield on our cash, what we're doing is bankrupting the government because they're issuing an infinite amount of debt effectively. And this goes back to Bitcoin. Why do we Bitcoin? This is why we Bitcoin, because fiat money is just printed infinitely. Before I go any further in the charts, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures Inc., PVI, DVA, Kraken. And there's been a lot of talk about gold recently. I talked about it yesterday a little bit. Gold has done very well after doing nothing essentially for 3 years, forming the handle of the cup and handle, which was also an inverted head and shoulders. But looking at gold relative to Bitcoin here on Kraken, PAXG is a gold stablecoin. It's got issues, it's got risks, but if you want exposure to something like gold in a crypto account, this is a great way to do it. At the moment, trend is still bearish, but this is clearly trying to bottom. Whether or not this is a triple bottom or an ascending triangle, it's trying. And from a Bitcoin perspective, what we don't want to see is PAXG BTC, the ratio, above 0.40. If that happens within the next couple of weeks, that likely means Bitcoin has broken down below 65K, probably closer to 60K, or even lower. So all this again is about dials and knobs within allocations. Do I want downside protection? Yes or no? What do I want that downside protection to entail? Do I want to invest in gold, metals, yielding instruments? Do I want to stay in alts? Probably not. If we just look on the USD side for alts, my guess is we are going to continue to see generally more red days than green days for a lot of these alts. And I think it's just easier to trade an environment where you are sure, broadly, that we have a tailwind rather than a headwind. Very few alts green on the day relative to the rest of the pile here, which is very, very red. So looking at S&P on the daily, we've been bullish since November. We had a perfect breakout, bullish DK cross, bullish Kumo breakout, bullish cloud. This was a handle of a cup and handle on the S&P. And for the past 3, 4, 5, 6 months, however long it's been, we've been holding above the Tenkin, this blue line. And up here, this is looking incredibly toppy. Inverted Adam in the EV, head and shoulders-y. And there's no guarantee or promise that this shifts back to 4,800. It is just something to watch for on the if-then statement decision tree. We could very easily just do nothing here for 2 months, 3 months, and chop around between 5,100 and 5,300. The bearish case would be a bearish TK cross with price through the cloud, and this probably takes us into May. If Powell comes out in May and says, hey, you know what, the market's right, we're not going to cut anytime soon, then I think it's even easier for legacy to roll over, for crypto potentially to roll over, which, by the way, we've seen stuff like that post-halving where the date itself doesn't really matter for Bitcoin. It's 2 to 4 months after halving where things really get interesting. So that is still very much possible. And this is something to watch for over the next 2 to 4 weeks. How bearish can we really get? But if we get a bearish TK cross with a close inside of the cloud here, that would be the cloud letting you know that there's a bearish edge-to-edge potential, very much like August, September, where we go back to the cloud, find it as support, get our bearish TK cross, and then wait until we get the close inside the cloud. That is the short signal. So up here, definitely very, very early to be shorting, but I think it's plenty on time to be concerned about the bullish trajectory up here. The Qs, the tech stuff, looks even worse to me. We've had months of a bearish divergence at this point. Downside on the Qs somewhere around 410. This probably breaks down first before S&P. But again, what are you looking at up here? You're looking at a double top. You're looking at inverted Adam and Eves. You're looking at head and shoulders type charts on some of these. They just don't look good relative to the past 3 months. This is also an interesting one. Bitcoin relative to the triple 3x QQQ. This thing has been in a tight range for the past 3 or 4 years. Post-halving, we tend to do several multiples on this eventually over time. We haven't done that since the last halving. So it's going to be interesting if BTC outperforms the triple 3x QQQ in the rest of this year and 2025 and 2026, because that will help pull even more capital into the ETFs, into spot Bitcoin, if the tech stuff just doesn't make sense. And it may be a sentiment gauge on the debt situation. It may be a sentiment gauge on the geopolitical situation. In a vacuum, this is an ascending triangle, and it would make sense if this would eventually move higher and into all-time high territory. So something else to watch on the periphery relative to just BTC against QQQ. Looking at NVIDIA and SMCI, again, all I can see here is toppy patterns, loss of momentum. You're breaking below the Tenkin, inverted Adam and Eve on NVIDIA. SMCI's got a head and shoulders here. And I just don't see an argument for sticking around to find out what happens. Both of these have had a pretty insane 3 months this year. And much like altcoins that have had a 2,000% move in the past 3 months, how much more do you really want out of this? The people that want more up here are the people who are late and are underwater already because they bought the top and effectively acted as exit liquidity. But both of these do not look bullish to me. And if the leaders in the market start to look bearish, it's going to be easier for the indices to roll over. And if you're looking for trade ideas or exposure on the short side, there are ways other than, puts or calls or whatever to express that idea. This is SOXS semiconductor 3x bearish ETF. Okay. This is not for the faint of heart, but as an idea, something to play here would be the inverse of the inverted Adam and Eve on NVIDIA. You see, double bottom type stuff forming here. So that's something interesting to think about. There's always the NVDS, the bearish NVIDIA ETF. And this thing, of course, has been down only for a long time now, but it's certainly one way to play these ideas. Very risky. Do your own research, not investment advice, but these look equally bullish as the semi stuff looks bearish. Shifting through to the Mag 7 here, most of these have either hit their targets, this is the cup and handle target, or they just kind of look soft and weak. It doesn't necessarily mean complete apocalypse. It just means momentum has kind of faded. On the weekly chart for Microsoft, I'm most worried about the TKC clamp here, the separation of the Tenkin and the Kijun there, as well as hitting the range for the cup and handle. So to me, again, if the argument is, do I want 5% yield or do I want to sit in Mag 7? I'm taking 5% yield, right? At least in the meantime. Amazon continues to break up well beyond the rising wedge, even well into the mega inverted head and shoulders target, flirting with all-time highs. Do I want to short something at all-time highs? No. But from a technical perspective, this looks weak, and broadly, I think there's less of a reason to sit in this at the moment. I just think there's going to be a better trade for a lot of this stuff coming up in the next 3 months relative to now. Meta just continues to be in the absolute stratosphere. This I can see pull back 30%. I mean, that would be nothing relative to what this move has been since late 2022. It's just been up only. There's been very little pullback in this thing since 2022. Of the Mag 7, Google continues to look the best to me, because if we contrast this with Microsoft, right? Microsoft hitting its target, Google just starting to break out. So on a ratio trade, it makes a lot more sense to me to pile into Google over Microsoft, just based on technicals, not necessarily fundamentals, but this looks like the safer bet to me relative to Microsoft. Netflix, similar to Meta, just straight up, it's had its chop, but I don't see a great argument to sit into this thing right now relative to yield. Apple looks very bearish. Other than Tesla, it's the most bearish of the Mag 7. It's getting a weekly bear cross here in the weekly cloud. And there's just, again, no justification on a technical perspective to sit in this thing, to continue to sit in this thing. It's already well below the 200-day moving average, well below the daily cloud. It just doesn't make sense. You're better off waiting for something like early 2023, where you had a weekly breakout, you had a bullish ticket cross, you had eventually a bullish cloud, all that stuff. I mean, look how bullish this was in 2020. It looks nothing like that here. It very much looks like it's headed to at least 160. You can measure out this double top lower, probably to 145 or something, but there's just no bullish argument on Apple, and there certainly hasn't been a bullish argument on Tesla for quite some time. Until this can get above the daily cloud at the very least, it remains bearish. And that's all there really is to say. It may have some interesting intraday moves, but trend is still very much bearish for Tesla. Onto some fintech stuff that's sort of adjacent to crypto. Square continues to hold inside of the cloud. The fintech stuff is certainly rate sensitive, so it would be beneficial from a bullish perspective if rates came down for something like Square. But as long as this can hold in the weekly cloud, I think it's fine. As a trade idea, I still like Square very much. Hood, I still like very much. This could pull back pretty significantly and still be fine, back to 14 or 15. And it may take some time to work its way through the cloud here, which I have the crypto cloud. But I think alts broadly, including the lower cap stuff like fintech, does best in Q4 based on how rates are positioned and everything else. This is TOST, again, another sort of fintech POS point of sale system, sort of pre-hood breakout, right? So some of this stuff looks okay. Some of this stuff just barely squeaking by on a breakout attempt. PayPal being one of them. Again, crypto adjacent-ish. And I think just needs more time. It still looks okay. And many of these charts have been beaten down for 2 years, 3 years. So from my perspective, they just need to be given the chance to reverse if they're going to reverse. Still, you've got inverted head and shoulders here. You've got a falling wedge breakout here. And eventually it'll be above the 3-day cloud. Likely, later in the year, but it still looks okay up here. MSTR to me is still very much overbought. The ratio on the treasury versus the market cap of MSTR still doesn't make sense to me. And I think this is probably headed back to eventually around 1,000, whatever the midpoint of the pitchfork is. It's up 5 or 6% today for, I couldn't tell you why, but it is. And once again, the argument in the near term and the midterm to throw money at this versus almost anything else just doesn't make sense to me. It just does not make sense to me. So if you're in this trade, I wish you luck. But if you go down to lower time frames, you're again seeing inverted Adam and Eve and or head and shoulders. And it just does not look like bullish continuation up here for MSTR. Even on the coin chart, you can see Adam and Eve or M double top type structure. And over the course of the multi-month trend, I think coin will be fine. But in the near term, you're probably better off waiting a little bit to make a decision, right? I mean, this could easily go back to 200. That would be the Kijun on the cloud. The broad trend, though, remains very, very bullish. WGMI is another one that's just been huge mega turbo chop. These are the Bitcoin miners. Individually, these names are sort of all over the place on what the charts look like. Some very bullish, like CleanSpark. Some very bearish, like Riot. Some sort of in between, IREN. This chart in a vacuum is not really telling you much of anything. I certainly wouldn't want to see anything sub 14 if I'm bullish. But if I'm looking to add to a position, yeah, anything lower here, as long as we can hold this diagonal, this multi-year diagonal, we're probably fine. It's just definitely not screaming bullish continuation at the moment, and definitely leans bearish here. On the flip side of that, if you want to look for bullish charts, commodities look very bullish to me. all over the place. This is Copper Miners ETF, clearly an inverted head and shoulders here above the weekly cloud for a few weeks now. Measures much higher. Gold, I already mentioned, looks great. And there's also XLE, which is the energy ETF, also continues to look very good. Just a string of positive weeks. This is the 3-day chart, but there's always something out there to trade. It doesn't always have to be crypto. It doesn't always have to be meme coins. There are lots of options. So when you open the aperture and find things you like, find trade setups you like that may make more sense than forcing something on Bitcoin here or ETH or Sol and just sort of waiting it out till the picture looks a little better. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.